One of my first ever jobs in finance was as a corporate foreign exchange dealer. So what this involved was me helping companies, primarily importers, with their foreign exchange needs. So companies would call us up and say, okay, I'm buying a piece of machinery. It's going to cost 50,000 euro. So give me the best rates. Yep. Now, as part of this process, sometimes often the transaction was not settling, next day or so, especially for a big import of something like machinery. The settlement for the import, let's say, might be 6 months later. Yep. But they will call us and say, yes, we want to lock in a rate. So let's make a deal. And so it was my job to price the currency. Either what we call spot. So if the transaction or the settlement was immediate, which was 2 days, then it would be a spot trade. That's the interbank spot rate or foreign exchange rate. So the rate you see when you look at currency markets generally would be the spot rate and would be the mid rate between the interbank buy and sell for that currency. Or it might be forward rate, where we would add or take away some what we call points, but we would reduce that rate or increase that rate based on forward pricing. And that forward pricing was just simply due to the differences in interest rates between the two countries. So the forward rate it's not based on expectation. It's not based, okay, I think the currency is going up, the market thinks it's going up, therefore forward rates increase no, it's not based on that. It's simply just based on interest rate differentials. Highly mathematical, highly calculable. But yeah, so that was my first real job. Now, currency markets are, when it comes to financial markets, are really the biggest markets in the world. Because it's not just about the role of finance and getting money from those that have that need. It's also part of the payment system, that is settling commerce, settling trade, transactions. But it's the biggest in the world because of global trade. Every cross-border trade, pretty much, needs to have some kind of currency transaction attached to it. Now, the biggest market in the world, if we were to break it down into types of securities that form that market, the biggest market in the world would be the foreign exchange swap market. And you can kind of see why this is, because again, foreign exchange markets are there to help settle all this global trade every day, trillions of dollars of trade going on. Yep. Whereas when it comes to stock markets or bond markets, there's not anywhere near that level of trade or exposures. And also, when we think about this thing we call a swap, what are they, and why would they form part of be the biggest component of the foreign exchange market and financial markets? Well, swaps, in essence, are really just switching exposures. We get interest rate swaps, for example. They're a very big and common type of swap where one participant might want to swap their fixed rate exposure for a variable rate exposure, floating rate exposure. In foreign exchange, what are we swapping? Well, there are two things we can swap in foreign exchange, really. We can swap future currency exposures, and we can also swap the term of future transactions. Now, an example of this, and this is really the main type of trade we get in this market. And let me just say that this market is really an interbank market. That is, the only real participants in this market are the banks. And so you've got a bank who is helping with foreign currency transactions and especially foreign currency forward transactions, future transactions that are locked in. And how do the banks make money out of this? Well, they're just trying to make money with the difference between buying and selling the currency at that forward rate, let's say. So they know they can go to the market if they needed to and buy it at a certain price. And so they will sell it to, maybe a corporate at a higher price. And the difference is their profit. They're dealers, so you make money out of the buy-sell spread. So you've got a bank, for example. Let's say they enter into all these different transactions with all these different companies and maybe other banks. And at the end of the day, all those transactions, they would hope, or they would probably try to see if they could all net off. That is, they bought some US dollars from someone and they sold US dollars to somebody else. Yeah, both sides, they're playing both sides of the transaction. And at the end of the day, it would be great if it was all netted off. Yep. But that's not likely going to be the case. Yep. And they're not likely going to try to drive transactions in that way. Why? Because they have the foreign exchange swap market. And so let's say at the end of the day, a bank has a long Swiss franc exposure for 3 months and a short Swiss franc exposure for 6 months. Well, what they might look to do then is to swap 6 months for 3 months in Swiss franc to net off that position, to make sure their exposure is zero. So it doesn't matter what happens with the Swiss franc, they're not going to lose money. They have a zero exposure to the currency and to time. And they can do that in one transaction with a swap. Instead of having to do one for the currency and one for time difference mismatch, you can do it in one. So that's why these foreign exchange swap markets are so big, is because every day every bank is going to have mismatches that they just want to get rid of. Again, they don't want to have an exposure, a net exposure to these things, because that's not where they make money. Not make money on speculating, they're making money on buy-sell spread.
Now, if you're a bit of a finance nerd like me, why don't you check out my Substack? There's a link in the description, and here you'll find additional concept notes, unedited videos, community chats, and much more. See you next time.